McDonald's, once the dominant fast food chain in America for over 4 decades, a place where families and kids could relish affordable meals, has witnessed a dramatic shift. The exorbitant prices of various menu items have caused the company to lose a substantial number of customers and billions of dollars in annual sales. Consequently, this has led to grave cash flow issues, accelerating its downfall within the very industry it helped establish. In this video, we delve into the reasons behind the colossal burger giant's waning momentum and unraveling presence in the U.S. market. The brand is losing its essence, and we explore the factors contributing to this decline. Despite being the pioneer that introduced fast food to America and standing as an industry icon for decades, McDonald's is now visibly fading away. The company has endured 2 years of relentless price hikes, spurred by the pandemic, resulting in a significant reduction in footfall as customers cut back their visits or opt for cheaper fast food alternatives due to food inflation. As conditions continued to deteriorate for the brand, its stock reached a 52-week low after reporting a notable decline in foot traffic. Month after month, numerous McDonald's restaurants across the U.S. have experienced a wave of customer defections, particularly since the third quarter of 2022. These trends have triggered concerns among investors and other competitors alike. Distressing sales growth and declining revenue have become recurring themes, with 9 out of the past 10 months witnessing a loss of customers in the United States. A recent analysis indicates that these woes are primarily rooted in McDonald's new pricing strategy, which is now under scrutiny. In April, McDonald's made an announcement about raising prices on several menu items for the second time within a single quarter. The decision was attributed to the rise in commodity prices and labor costs. The previous increase occurred on February 15th, with 5 combos going up by $1. However, it seems that consumers are growing increasingly displeased with the high costs at McDonald's establishments. According to data from RMS, 34% of customers are now opting for less expensive menu items, and 30% are choosing cheaper restaurants altogether. A substantial 40% of consumers feel they are getting less value from their McDonald's meals compared to just a month ago, and 82% of them blame it on the higher prices. During the first quarter of 2023, the company reported an average price hike of approximately 10% at its U.S. locations compared to the same period the previous year. While executives argue that the higher menu prices are helping boost earnings and revenue, analysts believe that this strategy is also shrinking the customer base, which could ultimately impact the company's overall profitability. Recently, a TikToker's video went viral, exposing the significantly high prices at a McDonald's location in Connecticut. Customers have expressed their dissatisfaction on social media, noticing that not only are prices higher, but their favorite McDonald's food items appear to have diminished in size and quality. The company's CEO, Chris Kempczinski, acknowledged that the higher prices are leading customers to buy fewer products, and there is growing resistance to the pricing strategy in some areas. The company has expressed concerns about its key units per transaction measure, meaning that cost-conscious McDonald's customers are reluctant to pay higher menu prices. As a result, some may opt to purchase only a hamburger without adding a side of fries, while those with more disposable income might buy premium dinner items but skip a drink or dessert. This trend has contributed to a significant drop in consolidated revenue, reaching $100 million in the past 12 months, with earnings decreasing by nearly $200 million. Over the years, McDonald's has faced a worrying decline in customer traffic since 2014, despite witnessing an increase in same-store sales driven by higher average checks. The introduction of new items, price promotions, technology, delivery services, and store redesigns has not effectively expanded its customer base. The chain's underlying problem of slower foot traffic has been exacerbated by rising inflation and increasing basic expenses, making it challenging for the company to attract more customers. Forbes contributor Larry Light predicts that relying on higher average checks with a shrinking customer base could require the average customer to spend $20 per transaction. Back in 2017, McDonald's experienced a decline of 500 million customers worldwide, and the trend of losing customer traffic continues to be a pressing issue. McDonald's attempt to compensate for declining customer visits by increasing menu prices to boost revenues might be counterproductive. While customer checks rise, the frequency of visits declines, leading to a further drop in customer accounts. This pricing strategy poses a risk to the company's future. During a call with investors, the CFO acknowledged that McDonald's cannot sustain its vast chain of 38,000 stores worldwide with a dwindling customer base. However, little has been done to address this concerning trend. Furthermore, higher prices resulting from increased menu prices can create deal loyalty rather than genuine loyalty. The strategy of relying on price promotional deals to increase same-store sales masks a more profound problem that even McDonald's executives recognize can become detrimental. Corporate initiatives such as recent marketing campaigns, complicated technology, and credit card-only drive-through menus or kiosks have not resonated well with McDonald's customers, turning some of them away. The expensive Experience of the Future plan failed to attract new customer groups to their stores. McDonald's is facing a significant challenge in reversing the declining trend of customer visits, and simply raising menu prices to increase revenues might not be a sustainable solution. A more comprehensive approach is needed to address the root causes of the declining customer base. Wall Street is expressing concern over the situation. In October, a financial analyst highlighted two major issues facing McDonald's: a continuous decline in customer visits and the unsustainability of the increased pricing strategy. The article stressed that relying on raising prices to boost short-term profits could lead to long-term failure. The analyst emphasized the danger of depending on higher average checks while witnessing a shrinking customer base. This approach conceals the fact that customers are leaving McDonald's. Making customers spend more for fewer items could have serious repercussions, as a small number of customers might end up shouldering a disproportionately high financial burden, requiring frequent visits to keep the company afloat. Moreover, expensive menu items are expected to contribute to further decreased transactions as customers perceive the brand as unaffordable, losing its previous essence. Over the past years, McDonald's has been attempting to reposition itself as a trendy and technologically advanced option for higher-income, progressive customers. However, this shift has not been effective, and the brand still needs to attract more of these customers to address its significant customer decline. It is evident that the current strategy is flawed, and digitalization alone cannot compensate for the lack of focus on food quality and service. To illustrate the flaw in the current strategy, let's assume that the average check is $6.50 and the average customer visits around 3.1 times per month. According to the analyst's calculations, if McDonald's keeps the average check at $6.50 and manages to encourage the average customer to visit just one more time every 4 months, it would result in an 8% increase in in-store sales, a significant improvement compared to the current reported comp sales. The key to financial health lies in increasing customer loyalty and frequency, as even a slight boost in visits can have a substantial impact on the company's overall performance. Financial commentators on Seeking Alpha point out that McDonald's current value is founded on increased debt used to support higher dividends and share buybacks, rather than the traditional success factors of packed restaurants serving high-quality, delicious food promptly to customers worldwide. This departure from the conditions that once made the company a huge success is perplexing. Instead of investing in maintaining and expanding its customer base, which can regularly visit its restaurants, McDonald's is focusing on attracting a public that already has numerous options among higher-priced burger chains. The ultimate goal for any business should be to attract more customers, have them visit more frequently, and cultivate loyalty, leading to increased sales and, consequently, higher profits. However, there is no indication from the recent earnings call that the corporate strategy has shifted. Continuing to pursue the same approach while hoping for different results is not a viable strategy. The analyst warns that relying on higher average checks from a shrinking, less loyal customer base is a recipe for failure. In today's increasingly competitive industry, being one of the largest and oldest chains no longer guarantees success and growth. Businesses must continually adapt and, more importantly, value their existing customers. The decline of McDonald's appears to be a result of self-inflicted issues, and this crisis may have significant repercussions for the company in the near future. It seems that America's most iconic fast food chain is at serious risk of collapse, and witnessing its downfall could be painful. Thank you for watching. Please subscribe and enable notifications for future videos discussing at different facets of the economy. Until next time.